4% of market participants are now expecting the Fed to raise rates by 1% coming July 27th. This is happening today because we added 373,000 new jobs for the month of June, giving the Fed the room it needs to raise as high as they want to get inflation under control. And with this upcoming CPI report coming next week, we might see a 1% rate hike start to get priced into the markets more and more. And if it does become over 50%, that's what the Fed is going to do. Now, why this is so important is because whatever the markets are pricing in, the Fed is going to do. Very rarely do they deviate from market expectations. So if we continue to get good employment data, a really hot CPI report coming next week, which we are already expecting to get another new high for year-over-year inflation coming just here next week, and we'll talk about that in just one second. If markets start to price in 1%, we're going to get 1%. And given what the bond rates have been doing, the bond yield, and what they have been doing over the last couple of weeks, that means bond yields have to go much higher in a very short amount of time. And that will mean a lot of downside for the markets to come throughout the month of July. So we are now pricing in a 4% probability of a 1% rate hike. That is because the job market came in so hot. Healthcare and social assistance saw the biggest jump, followed by professional and business services. The leisure and hospitality sector saw another strong month, adding more than 60,000 jobs. And I know I said 273,000 new jobs, but it's actually 372,000 new jobs. And this is directly what is making the probability of a 1% rate hike go up today, because this was not even a possibility as of yesterday. The next CPI report comes out Wednesday, July 13th, and we are expecting 8.8% year-over-year inflation. This would be a new high for 2022, but there are some analysts even calling for as high as a 9.1% CPI reading year-over-year for the month of June. If that happens, the markets might aggressively start to price in this 1% rate hike, and specifically why that means bond yields have to go up and stock prices have to go down is because of this. So about 10% of the M2 money supply, about $2.2 trillion, is currently being held in the reverse repurchase agreement program. This is a program where the banks can take their excess money and lend it to the Fed overnight, literally at 1:15 p.m. the Fed takes this money, they release it at 12:45 p.m. the next day, but it goes off of the federal funds rate, and that is 1.55%. Now ask yourself, why would you put your money in a 10-year treasury bond if you could get the same amount from the Fed overnight? Right? So if the Fed raises rates from 1.5% all the way to 2.5% or 2.75% here next month, well, why would you buy a 10-year bond that is paying you a little bit over 3%? Well, you wouldn't do that. You have to be incentivized to put your money up for 10 years, and that really factors into inflation. So if markets start to expect inflation to last a lot longer, if those are the kind of readings that we are getting, new highs to inflation, well, the bond yields have to go up in a big way. The Fed will have to tighten in a big way. So when the bond yields go up, that makes interest rates go up, that makes the cost of capital go up, and that makes your algorithmic trading programs essentially short stocks and sell stocks from those portfolios. So that in a nutshell, the Econ 101 version of all of this is the Fed raises rates more aggressively, the bond yields have to stay higher than the federal funds rate because you're putting your money up for a longer duration comparatively to the reverse repurchase agreement markets, and that pushes down future expectations for valuations at all companies, but specifically growth companies like your Apples, Googles, Amazons that really control the broad markets, meaning you have to see more downside in the stock market. The only reason why bond yields have dropped from 3.5% over the last couple of weeks down to, at the low, about 2.8% was because fears of a recession. Now, if we get a recession, that usually means deflation in a massive way. That's why oil has come down in a pretty big way over the last couple of weeks, and that would mean the Fed would not have to raise rates as aggressively aggressively and possibly start cutting rates a lot sooner. But if we keep getting good economic data, if we keep getting a strong labor market, well, you're going to have to see the bonds go up in a big way. You're going to potentially avoid a recession. Even if we do go into a small technical recession coming by July 28th later this month, actually one day after the Fed raises rates, July 27th, well, that's the worst case scenario. The last thing you want is a technical recession and employment data good. At the same time, inflation is 9%. That's a recipe for disaster in the bond market. On a more positive note, today, the Atlanta Fed GDP Now tracker, this is the estimate for Q2 GDP, is coming in at a negative 1.2%. This is a lot better than the negative 2.1% we just had only a couple of days ago. So it does still look negative, but not 2% negative. And this would still mean a Wall Street technical recession. Well, we're currently in one. We will get the advanced estimates for Q2 data for GDP coming July 28th. We have the Fed rate hike by July 27th, depending on if that's a 75 basis point rate hike or a 1% rate hike. I think bottom line, it means the bond yields have to come up in a big way. And during that time frame, we are going to get large company earnings. And if those earnings disappoint in a big way, well, you could be looking at some pretty substantial downside. The margin debt is still sky high and has not really come down in a big way at all. Less than 15% from the peak in 2022. So this is a real concern, at least here for the short term, that we could hit some new lows, but that could also mark a bottom for the markets once that flush out event does happen. Now for next week, you could also say this is a positive thing if you want the markets to rally from here. I am in the camp of, I just want the markets to flush out to the downside, see a crash, and then be able to make our way back to the upside in a more sustainable way. And for next week, well, we don't really have anything for Tuesday and Monday as far as economic data that can move the markets. But then on Wednesday, like I said, you do have CPI. And then on Thursday, you do have PPI month over month for June. And then on Friday, you do have the retail sales month over month and the Michigan Consumer Sentiment preliminary survey for July. All of these will be important, but there's not a lot of data. We do have important data, but not a lot. So I think the markets are really going to pay attention to that CPI report coming out on Wednesday, as that does kick off all of the economic data for the week that can move the markets. And depending on what that comes in as, you're probably going to get a very bullish or very bearish reaction. I imagine it's probably going to be a bearish reaction, especially the more we rally heading into that actual release, because we are up. Let's go ahead and draw a trend line from 362 to where we are now at about 387. Even earlier in the day being about 390. I mean, that was up about 7.5% from the bottom. So we do have more room, more cushion before we hit new lows, the higher we bounce heading into CPI. So the higher we go, more likely to get that bearish reaction after next Wednesday. But it could be seen as a positive thing. Monday and Tuesday, we don't really have any economic data that will move the market. So I did want to throw that in there. Now, as far as the S&P 500, something that is very critical that you guys know is that the markets are really moving for the most part based off of option activity. For today, you are seeing a lot of very bullish option activity, but not as much money worth, right? Yesterday, you know, you're sitting at $1 billion worth of orders, $1.1 billion worth of orders with a 91% positive order value. Well, today you're looking at about 3,000 orders totaling 388.85 million, positive order value of 91%. So it's still very positive, but you're seeing not as many dollars flowing into these S&P 500 options. If we go out to July 29th, I think this is where we could start to see more downside in the markets as the Fed does raise rates on the 27th. The advanced estimates for GDP comes in the 28th, and we have big company earnings this same week. I think you could see more downside. And what we're seeing for the total amount of calls comparatively to puts, out of all of the options on this expiration for the S&P 500, 21.54% of that activity is calls, and 78.46% of all options on that expiration are put. So a lot of people are betting that the price of the S&P will be down and will be going down by July 29th. And that's basically what you're seeing on a lot of expirations. But that one is specifically a lot more bearish than some of the other ones. Some of the other ones like July 13th, I mean 40.65% call activity, almost 60% put activity. It's not as large of a ratio. Even for this week, this expiration was about 36.48% calls and 63.52% put. So we're just hanging out down right now, almost 0.5% here in the markets. Today could wrap up to be, bullish, bearish. You might see some very violent moves towards the end of the day. It wouldn't surprise me if we go either direction, but it really has surprised me over the last couple of days when you have seen Fed officials like Waller and Bullard back another big interest rate increase, and you're seeing the markets pricing in the possibility of a 1% rate hike. You're seeing the bond yields finally starting to come up. People fearful about a recession, but not only that, a Fed-induced recession, and you're not really seeing the markets reacting in the same way. We're really having a very strong week this week, and it really shouldn't have been that way. So the markets are disagreeing with the Fed is disagreeing with the markets. We'll see which one breaks first and which direction we go in, but really towards the end of July, August, you need to watch out below because things are going to get pretty dicey here in the markets. So that is going to be all for this video. If you guys found value out of it, hit that like button and subscribe to the channel. But most importantly, comment down below. Do you have any questions on this information? Do you have anything to add to my theory? Add it down below in the comment section. Now, thank you guys for watching, and I will see you in the next one.